Good afternoon, and thank you for being here today. We are very excited to present two compelling investment opportunities. Both of these deals have their own unique challenges, but we believe that we've come up with some creative solutions to mitigate these issues and generate favorable risk-adjusted returns. Before we dive into the two deals, let's briefly run through our agenda. We're first going to give you an overview of our fund. We're then going to talk about our key investment criteria. And lastly, we're going to provide a detailed analysis of both opportunities. We're investing on behalf of Highland 2, a $500 million closed-end fund with approximately 7 months left in the investment period. To date, 70% of the fund has been deployed, leaving us with about $150 million to put to work in a relatively short amount of time. We are opportunistic investors. We target returns of 17% and look for multiples on invested capital of 1.7 times. Let's now go through our investment criteria to give you a better sense of the lens that we view these opportunities through. First, we look to partner with strategic operators. We want GPs with local operating expertise and strong track records. Second, we look for market drivers. We want assets in infill locations that are proximate to ancillary services. Third, we seek asymmetric returns. We want to acquire assets at a discount to their value and that provide cash flow. And lastly, we are extremely conscious of capital structure. We only want to do deals where we can achieve our returns by using leverage in a sensible manner. We believe that both St. Paul Plaza, an office complex in the affluent suburb of Oakdale Park, and the Jane Hotel, a hotel in the heart of Dune City, meet all of these investment criteria. And we are recommending that we proceed with both opportunities. With that, I'll pass things off to Joe to talk about St. Paul Plaza.
St. Paul Plaza is a best-in-class office located in the most affluent suburb, close to key decision makers, and has a very prominent lifestyle center across the street and is close to the airport in the market. We're going to acquire this asset at 90% occupancy at above market rate, generating a going-in cash yield of 14%. Moreover, we're acquiring this asset with a strategic partner with a proven track record in this asset type in this submarket with strong tenant relationships. And that's critical to us, because the key to this investment is our leasing strategy. Leasing really is our largest risk. We're going to experience significant rollover in our hold period, and we need to mitigate that risk with an aggressive blend and extend strategy that I'm going to highlight shortly. Additionally, with any suburban office, you have to be concerned about urbanization. But this is located at First and Main in the best suburb and is the best-in-class asset. So we think this is going to be a fortress, even if we see some urban flight. This should highlight our key risk. We're going to see 2 floors vacate every year for the first 3 years, and then potentially our anchor tenant role at the end of year 4. However, we're going to hold on to 1 fully leased building at above market rate. That above market rate is critical because that's why we believe we can execute on our leasing strategy. We're going to blend and extend. What that means is we're going to open up our leases on day 1 and start negotiating aggressively with our tenants. We want extra term. And in exchange for that extra term, we're willing to give our market rent premium back to them, creating savings for them. This is what our blend and extend strategy looks like. We're currently at about a 5% rent premium to market. So we're going to pass that rent premium on in exchange for additional term. As we do that, in advance of their leases terminating, they're going to get a year or 2 years of cost savings. What the ultimate result of this is about a 2% rent premium at the end of the hold, and that's because we have that 1 in-place asset that is fully leased through the hold at above market rates. Ultimately, that is a huge mitigant to us, and we are generating a 14 going in cash yield and pulling out 89% of our equity by year 3. And with that strategy in mind, I'm going to turn it over to Anthony to talk about capitalization.
Thanks, Joe. So when we thought about the capitalization of this project, we wanted Joe's leasing strategy to inform our decision on which type of debt we chose. So the two term sheets we looked at were from a bank lender and for CMBS. And initially the CMBS opportunity seemed appealing because it would allow us to get closer to our levered return target sooner. But when we think about the leasing strategy, we really think the bank debt makes more sense for two reasons. The first is the lower loan to cost. We think that this project is better suited with more prudent lower leverage because we are executing this leasing strategy in the near term. And the second is having the flexibility of a bank lender in case we have to go back and actually have a discussion with a person about changing the terms or some part of the debt deal we have with them. One idea we had was that after the third year, once we execute the blend and extend strategy, is to rethink our debt structure after taking on the bank debt initially. We think that it would make sense at this point to increase our leverage from 60% to 80%. By this point, the asset is stabilized. If we were to assume that that extra 20% was expensive debt in the form of mezzanine debt, we still are at a 1.7x debt service coverage, and this gives us an opportunity to give back 90% of the initial equity in the third year. The third leg of the stool, when we think about this acquisition, are the joint venture terms with our equity partner, GLP. Now, again, nothing stood out as completely crazy with this term sheet they sent us, but there were two areas we thought that we could change to better align our interests with GLP. The first is on the promote structure. We were comfortable with the 12% preferred return, but we wanted to push that first hurdle out to 17% and a 1.7x multiple because that better aligned with our investment fund's goal of 17% IRRs and 1.7 multiples. After that point, we were comfortable giving them much more of the upside as long as it aligned our interests in the near term. The second lever we pulled was on the put option. We obviously don't want to be in the position where GLP can put this property to us at any point, but we understand their motivations. They want to be able to monetize on their promote sooner. So we decided to allow them to potentially keep the put option as long as there was a 1.7x multiple within that so that they couldn't put the property to us until we achieved our fund return target. This is an example of, from their perspective, what they might be looking at, thinking about their original terms versus our proposed terms. And as you can see, the bigger gap is sort of in that intermediary period before we hit our target return. But after that, they catch up very quickly and actually surpass their initial promote. So a summary of our underwriting, we'd like to hold this asset for 5 years. We're exiting at a 7.5 cap rate, which is 0 cap rate compression. That's where we're entering as well. And it gives us a 17% IRR and a 1.7x multiple, almost to the nose of our fund requirements and targets. I'd like to point your attention too on the attribution chart on the bottom to our downside, which is an 11% IRR. And we flexed a couple of the items that we thought were most sensitive in this project. The first is the blend and extend leasing strategy that Joe mentioned. In the downside scenario, we assume 9 months vacancy between each lease roll, which means that 60% of the space at some point is vacant for 9 months, which is a pretty severe vacancy. We also did not include any additional debt. And then lastly, when we think about this, we want to think who's going to buy this from us when we do exit in the 5th year. And we think that this is going to be a core plus buyer looking for cash flow. And so we're thinking REITs, open-end investment funds, and potentially pension funds. And finally, the last thing that we did not incorporate into our base case, but we still think there is an opportunity for the next buyer, is upside on the additional FAR that we haven't used, because right now there's no demand for it in the market. But that could be great for a future buyer who wants to build a suit. You could put medical office there. In the interim term, there's also 10% vacancy, which if the market picks up, we could potentially fill. And finally, there's the creative space that the next buyer could work with. We really, really are excited about this asset, and we really like our partner, and we think it'd be a great fit in our fund. And with that, I'll turn it over to Mark to talk about the Jane Hotel.
Thanks, Anthony. So obviously a very different asset, but still very exciting, lots of upside. The Jane Hotel this opportunity was brought to us by Sutherland, a best-in-class JV partner that we've worked with and made money with before. It is a 120-key hotel. It's in a historic building. It's in a great location, but it has been improperly managed. So even so, we're still seeing almost 80% occupancy, but it is trading at that 26% discount to comps, We really like that low cost basis. Our plan with this asset is to renovate, hire a third-party institutional manager to really drive rates and expand margins. And we are going to maintain flexibility operating this as an independent hotel for now. Nick will talk about that later. Some risks, absolutely. It is a hotel asset. That means it's subject to volatility from seasonality, other macro factors, even new supply coming online. But we think that the greatest mitigant to all these is location. Prime, infill, CBD, close to 2 convention centers, several Fortune 500s. Again, as I mentioned, even with that poor management, we're still seeing almost 80% occupancy. So when we do bring in Gemini, that third-party institutional manager, we expect to see tremendous upside on that. If we do need additional lift, we do have the added benefit of a soft brand affiliate. But again, I'll leave that to Nick in discussing why we didn't choose to do that now. You also can't really talk about market risk without at least mentioning Airbnb. Fortunately, our target demographic for guests, which are high-value corporate travelers, don't overlap with the majority of Airbnb users. Furthermore, Airbnb's urban stock, actually 70% of it is outside CBD. So at this point, we don't really feel like they're a real competitor, and we feel confident moving forward. At the end of the day, the bottom line, we're getting in there at such a low cost basis. We think that there's significant cushion on all these factors, and we're really confident to execute our strategy. Number one, obviously renovation. So our goal here is to create a differentiated experience for the corporate traveler. We want to create a vibe that's warm and inviting, energetic yet elegant, and the goal is to really draw people into the asset. Flexible optionality in terms of meeting space. So meeting a client or a colleague, or even just sitting and reading a newspaper in the quiet library, or hosting a small networking reception in the open kitchen-style pantry. The goal is to really service all needs, all functional times of the day. And at the end of the day, at $25K per key, we feel confident that the guest is going to leave with an incredible experience. So now to Nick to explain why we're maintaining brand flexibility here.
Thanks, Mark. Ultimately, for hotels, the reason to brand is significantly driven by the fact that it affords the opportunity to get into a distribution system. In addition to that, a guest loyalty system, additional cost efficiencies, and operating understanding as well. Ultimately, for us, we decided to keep the Jane Hotel independent, and that was driven primarily by the continued strength of the hotel market. Currently, what we're seeing is occupancy above 82%, which is significant from a compression point of view. We feel that we have the necessary base business that we do not need to bring on a brand. In addition to that, we're also extremely excited about the hotel's CBD location. The fact that we're walking distance to 2 convention centers is extremely significant for the reason that these will book 1 to 2 years in advance. And we feel confident that we no longer need to rely on OTA business as we have in the past. We feel that with our operating partner, we will be able to implement the necessary yield management expertise in order to continue to push rate. In addition to that, we also are confident in our partner to expand margins as well. This has been demonstrated in their deals in the past, and we feel pretty good about that going forward. Ultimately, the decision to brand, although it would provide some upside in terms of top line, we feel that it is extremely outweighed by the additional costs, both in terms of management fees, but then also from a PIP, in that we would need to meet the life safety requirements of a brand. In addition to that, we also feel good about our design-centric ideas. Moving forward, when looking at the RevPAR penetration analysis, you'll see here that there is a significant gap between the Jane Hotel and its competitive set. For us, we see this as a huge opportunity and feel that if we're able to effectively execute our business plan, including the renovation of the guest rooms, implementing proper yield management expertise, we feel that we'll be able to close this gap. The other thing that we wanted to also talk about is adding additional meeting space. Although this may not be a large addition to the top line, we feel that it will allow us to book small group business, which will further reduce our small 120-key box size. Moving forward, one more, we also took a look at the NOI growth attribution and where we will be entering in 2016, and ultimately where we would be also stabilizing in 2019. I've already had the opportunity to talk through the penetration improvement and the margin expansion. Now I'll turn it over to Dan, who will talk about the market. Thanks, Dan.
Great. Now that you've heard about why we like the asset, I'm going to go through our proposed capital structure. We looked at the 2 debt term sheets we received, and the first thing we noticed on the bank note was that there was a recourse obligation. As an opportunistic private equity fund, recourse is just something that we don't give, right? So we're going to look to our GP partners to provide the recourse. However, we also understand that the GP partner probably doesn't want recourse either. So we're going to get a little creative here and say, look, we're okay with the more expensive debt fund option, and you don't have to provide recourse. In exchange, we would like to get better JV economics. So essentially what we're saying is, let's take the debt as a bargaining chip for the equity. And we also like that we were getting $5 million of additional proceeds from the debt fund, which we can adequately service with NOI day 1. Now, with respect to the JV structure, I just want to remind everyone that Highland has been a partner with Sutherland for years. We've made money with them, we like them, and more importantly, we trust them. So we don't want to be offensive by coming back with really aggressive changes to their term sheet. So all we're asking for is a 12% preferred equity hurdle, at which point we'll give them a 20% promote until we receive a 15% IRR and a 1.7x on our equity. And then even in a home run situation, we're willing to give them 60% of promote, which is more than what they asked for. One thing we will fight tooth and nail for is that buy, sell, and the for sale option. What we don't want to do is we don't want to let Sutherland prematurely sell the asset and monetize their promote. So we're going to build in a 1.7 equity return hurdle on our equity. And at that point, if they hit that, we're agnostic to whether we hold or sell. But ideally, we would love a unilateral control of the sale since we're 90% of the equity. But this is a relationship business, we get it. And then moving on to properly aligning our property manager, Gemini. One of the best ways to do that is to give them an incentive management fee, right? Which is 15% of every dollar of NOI that they achieve above underwriting. But we kind of bifurcated that in 2 ways. One way to think about it is if the market goes up and the NOI goes up, we don't really want to reward them for that because it was not value add management. So we want to measure their outperformance through a NOI, GOP margin, through RevPAR penetration, and guest service satisfaction scores. And if they achieve all 3, we're more than happy to give them 50% upside in their base case management fees. And we have an example we'd love to walk through during Q&A. And if you'll see here, the blue line behind me is the original proposed terms, and the red line is our counter. All we do is we shift out the preferred hurdle to 12%, and then at a point where we receive 1.7x on our equity, that's when they really start catching up to their original proposal. We expect to hold this thing for 5 years and sell the hotel for $595,000 per key. That sounds like a really high number, but if you look at the comparable trades today, it's actually lower than a few of the hotels in there. So 5 years out, we feel pretty comfortable with that price. So we're expecting to build to just under an 18% return on our LP position. And if you look at the return attribution chart, we see a pretty big pop from leverage. So what we wanted to do was we wanted to stress the interest rate, build in a 300 basis point expansion on LIBOR, and we're still getting to a low teens return. And in our downside, we expected a 12% decline in RevPAR across 3 years, and we're getting to a 7%, which is somewhat palatable to us given the situation. Now, with respect to a potential buyer, you heard from Nick, we are operating this as an independent hotel because we think the hotel doesn't need it in this type of market. I know there's a lot of opinions out there that are for branding this, but we basically want to sell this dream to somebody else. Right? So we don't think locking this up in a long-time franchise agreement is going to generate a deep pool of buyers. So what we're going to do is sell it unencumbered with the brand optionality in place. We would ideally like to sell it to a hotel REIT or a hotel dedicated fund. And of course, everyone's favorite option, a really rich foreign investor. And Sam's going to bring us home.
Thanks, Dan. We believe that we are in the middle to late stages of the current cycle. Due to this, we only want to invest in deals that can stand up to stress and that offer some form of downside protection. We believe that both of these assets provide that. Furthermore, we like the way these assets play off one another in our fund. We think about this as a barbell strategy. You have an office asset that's spitting off cash flow combined with a hotel asset that provides significant runway for growth. Finally, we're in a low yield environment. We have 7 months left in our investment period. We have $150 million to put to work, and we simply cannot afford to pass on deals that provide both downside protection and that generate returns in excess of 17%. Thank you very much for your time. We will be happy to answer any questions you may have.
Thank you. Great presentation. The CapEx that you're going to put in to revitalize this, I understood that the thing was over improved by the existing buyer and they're underwater because of that. So how much extra capital are you layering into this renovation?
You're speaking to the hotel, correct?
Yeah.
Yeah. So this was a case fact that we were going to build in $3 million of CapEx across 2 years. We weren't necessarily sure how that money would be spent, but in a normal situation, you spend it on the rooms, you spend it on the lobby, and also we were going to take down some of the restaurant space in the mezzanine level and build in meeting space. And basically, the meeting space is really important to us because it allows us to book smaller groups, which shrinks the size of the hotel, and we can therefore sell a smaller hotel to generate higher rates.
What are you counting on your partner to do for you on the office asset, your GP partner?
Yeah, so they have a strong track record in the market. They know all the local players, and we're really focused on retaining our current tenants. So that's why we want them to get in day one and start working with our tenants, open up the leases, figure out what levers to pull to keep them in place, because we really love our 14% cash yield. I mean, in this environment, that's such a good mitigant. And so we want to keep them in place, and we're even willing to give them a lot of savings in rent just to keep that occupancy up. So we're expecting them to negotiate right away, but be friendly and work collectively with our tenants to find a solution for everybody that works.
So what's your plan B when the tenant says saving a couple of bucks on rent isn't going to help me recruit tenants to come to an old building? What if you lose the tenant? What are you doing?
Yeah, so this is a rectilinear box. So it's very, very, very flexible. We've got the ability to put in open floor plates. We can easily multi-tenant it. So we have lots of opportunity to attract other tenants from less well amenitized assets in the building, and we can multi-tenant it and take smaller tenants. And to us, it's just key to keep that occupancy up, especially in a downturn. So our strategy would use the best-in-class asset to potentially lure tenants from other places in the market.
So did you look at the hit to your return? How long it would take or what you would have to spend to get somebody in?
We underwrote that 9 months of downtime.
Yeah, so basically it's 9 months of going dark for 60% of the building throughout the life of the hold.
And we're still hitting 11% return.
Yes, sir.
On the office building, how do you think about the parking that you have there relative to your competitors in the market? And then also, how do you think about the parking relative to trends that we're starting to see in office usage?
So we have a 3 parking ratio, which is pretty attractive, I think. Additionally, if there were any issue of lack of parking, which I don't think there is, we are across the street from a lifestyle center with ample parking and other complexes, so we could potentially rent spaces elsewhere. We're going to conceivably sell the dream of additional FAR, so we could have issues related to parking with that as it eats into our land, but that is likely not a strategy we're going to pursue because we're currently trades are happening at below replacement cost, so it doesn't make sense for us to build, but we'll sell that dream to somebody else and maybe they see the upside in that.
Can you clarify whether the mezz piece on the office was upside or base case?
Yeah, so that was base case. And I think that the key there is that once the rent roll is stabilized, we're confident in adding more leverage to the property. We initially thought about a true refinance with a bank, but given that our bank lender now with a 90% occupied building is only willing to lend us 60% on loan to cost, we're not 100% sure that we could get 80%. So we just underwrote a more conservative case by considering it as mezz at a higher interest rate and use that as our base case.
So if you can't get the early blend and extend, do you know what your returns are without the mezz piece?
Yes, so the downside scenario that we showed, the 11%, is no mezz, so it's 60% leverage throughout the life of the deal, and that includes the 9-month vacancy rollovers that Joe was talking about.
In both cases, your base case, did you assume the proposed JV terms that you had on the table, or was it what they proposed?
I can speak to the office. In the office, we in both deals, we use the new terms, our proposed terms.
Question on the hotel. Sure. I understood your analysis on Airbnb, high-end business travel. And then I understand also the analysis where you didn't want to go branded today, at least keep the soft brand. But maybe talk a little bit more about how you think about the weekend business, because the leisure traveler, that for a lot of hotels, that is the softer period of time when the business traveler isn't occupying the hotel.
Sure. The first thing we want to point out is that it's an 80+% occupied market. So what that means is this hotel's at least sold out for 4 nights a week, right? So any additional business we'll get on the weekends is obviously a great benefit to us. And I appreciate your point. We did a lot of research into leisure travelers, right? But at the end of the day, you're not going to get a significant increase in your ADR from taking on too much leisure business. And the last piece of primary research that we did was we wanted to find out a little bit more about Airbnb and their business, right? It just doesn't seem fair to real estate professionals that where we spend so much time doing entitlements and zoning that Airbnb can come in and just take away our business, right? So, but we're looking at cities like Los Angeles, who's trying to pass some regulation against that. And I think, to your point, though, it is a risk to our leisure business, and but we feel pretty strong about our business transient type of segment. So,
yes.
On the office building, how accretive was the mezz piece? What was the base case doing the blend and extend without the mezz, incurring debt in place, versus the base case adding the mezz on?
sure. So the analysis that we ran was, look, we're going in at a 14% going in yield, right? Let's just assume we clip a coupon for 5 years, do the blend and extend, and then sell with slightly higher NOI, right? Because we do have a little bit of a premium. And then at that case, I think the deal came out to be about a 15% IRR. So,
okay. Oh, sorry.
Oh, I was just going to say the primary benefit of the mezz is that, look, we only have 10% of our equity at risk after year 3. But if we didn't get the mezz and we executed a strategy, our IRR comes down to several hundred basis points, maybe 200.
Okay, thank you, Blue Coral Investments.
Thank you.